$500 billion in fresh capital is being lined up behind NVIDIA's GPUs. That is the single biggest number to hit the tape today. After the bell today, 3 earnings shocks, 1 Wall Street financing pact, and a first-ever FDA approval that could reshape flu season. NVIDIA signed memorandums of understanding with 6 of the largest asset managers on Wall Street to build a new compute financing pipeline. The lineup reads like the entire private credit universe: Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR. The stated goal is to mobilize more than $500 billion of third-party capital directed at AI compute infrastructure. The structure treats NVIDIA's GPUs as infrastructure like collateral, the same way airplanes and data centers get financed today. Financing routes through special-purpose entities that issue private credit notes backed by underlying compute contracts. In effect, AI hardware is being repackaged into a yield product that institutional lenders can hold to maturity. That is a structural shift. NVIDIA is no longer just selling chips, it is architecting how those chips get financed at scale. After the bell yesterday, PepsiCo's headline earnings looked electric until you read the second paragraph of the release. Reported earnings per share jumped from 92 cents to $2.18, a 137% year-over-year leap. Almost none of that improvement came from selling more snacks or drinks, it came from a comparison quirk. The 2025 base quarter carried $1,860 million of pre-tax impairment against the Rockstar and B and Cherry brands. Strip that one-time non-cash write-down out, and Pepsi's own core operating margin actually fell 40 basis points. Core margin slid to 16.8% from 17.2% a year earlier, a genuine deterioration, not an improvement. And PBNA, the North American beverage unit, reported volume down 4%, the drinks business is still bleeding. Coca-Cola then told a cleaner margin story after the bell, but a much messier cash flow story. Operating margin expanded to 34.92% from 34.14%, that piece is real, high-quality improvement. First-half operating cash flow swung to positive $7.5 billion from negative $1.4 billion a year earlier. That is an $8.9 billion reversal, which looks at first glance like a step change in the business. But $6.17 billion of the swing, a full 69%, is simply the absence of last year's Fairlife contingent payment. And a $14 billion tax dispute with the IRS still sits entirely off Coca-Cola's balance sheet. Honeywell Aerospace, meanwhile, fell 23% in its very first quarter as a newly independent listed company. Adjusted EPS came in at $1.87 versus $2.13 consensus, a 12% miss on the debut print. The culprit is not weak demand, it is a physical shortage of engine castings capping output. Engines and power systems grew revenue only 1% despite a full order book waiting for hardware. Implied segment costs rose about $96 million against just $14 million of additional revenue, a nasty operating leverage inversion. That squeeze drove a 32% drop in segment EBIT, and the market punished the stock immediately. DoorDash, meanwhile, grew revenue 36% to $4.45 billion, with marketplace gross order value hitting $33.1 billion. But GAAP net income fell 30% to $200 million, mostly on recurring purchase accounting charges from prior deals. Public Storage reported EPS up 45% to $2.55, almost entirely on foreign exchange gains. A $163.3 million swing on the company's euro-denominated notes more than accounts for the whole net income increase. Strip that non-operating FX benefit out, and core FFO actually declined 2.6% year-over-year. ICE launched a $3.5 billion investment-grade bond sale today to fund its MarketAxess acquisition. The transaction values MarketAxess at $6 billion, or $167 a share, a 33% premium to its July 30th close. And the FDA approved Moderna's mFlusiva, the first mRNA flu vaccine ever cleared in the United States. The Phase 3 in 40,805 adults over 50 showed 26.6% relative efficacy versus a standard dose flu shot. Watch tomorrow's open for how the tape prices Honeywell Aerospace is casting bottleneck and Pepsi's underlying margin slide. And keep an eye on the NVIDIA financing pact all week. It changes how the market underwrites data center capex. Full analysis on LineVestNews.com and subscribe to LineVest Daily for tomorrow's brief straight to your inbox.